Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening each and every week. You know, you can hear us on radio, you can see us on YouTube, but we are with any number of great podcasts, and some of the podcasts that are out there. I think, Daryl, do you have a list of those? I think it's Stitcher,
Yeah, I do.
Stitcher, Spreaker, Apple, Google New.
Okay, I'll start from the bottom.
Thank you.
Since you started from the top. Apple Podcast, Spotify, Spreaker, Stitcher, iHeartMedia, Radio.com, YouTube, Podclips.io, and of course, The Mortgage Voice.
Okay, excellent. Now, Podclips themselves have become the actual rebirth of a lot of what we do in radio. Radio has traditionally been the place to go for many things. One, it's easily accessible. You can reach it almost anywhere, driving around in your car, portable. But podcasts have really brought back to the medium a whole different level of interest. And now most people have podcasts. Most people in my business, in the mortgage business, listen to podcasts. And one of the great places that we talked about earlier, Daryl said, was podclips.io. Great place you can go to get financial information, not only from me, but from a couple of the other podcasters, new podcasters, maybe people you haven't heard about, but they have lifestyle, they have sports, they have health, certainly. So if you're looking for a central place to find great podcasts, podclips.io. I am Jeff Barton, and this is The Mortgage Voice. Thanks very much for tuning in. And again, here we go. All right. Rates came down. Stock market went up. Yep. It's kind of a seesaw up and down thing until we get really inflation and a handle on what's happening both with employment and long-term prospects of that recession. All this means, yes, it's a very uncertain time. And so I had a friend of mine who is also a person who works for the company that I work for, Malibu Funding, 68230, I think is the NMLS number. Anyway, they came to me the other day and they said, look, I just bought a house in Las Vegas and I am thinking of maybe putting my house back on the market. What do you think? And by the way, I've had this last week several people call me, write me, email me, text me about what is happening in the market. What's going to happen? They want some idea from somebody, I guess, who they consider an expert. I guess I am an expert in some respects in that I've been reporting on this stuff for 10 years plus through this particular radio station, radio network that we're involved with. One of the things about the economy and what's happening is that, yes, it is very uncertain times. So I told this person, actually a friend of mine, as I said, and they came to me and said, what do you think I should do? And I said, okay, well, where is it that you live in? She told me where it was live. It was a small town in Southern California. I said, look, you are off your June highs. June was the highest point that houses were selling in the United States, especially in Southern California. But where are you going to be in 6 months? And that's the crystal ball. Everybody wants to view, where are we going to be? When are rates coming down? When? I said, if you're looking to sell your house, and there's a lot of talk about recession, and there's a lot of talk about maybe mortgage rates going up a little bit, certainly the Fed raising the short-term interest rates going up a little bit, do you think housing prices are going to be higher in 6 months than they are today, or lower than they are today in 6 months? She says, probably lower. I said, yeah, probably, because even though the employment numbers are great, and they're going to be great again in September when those numbers come out on Friday. And again, when you hear this, those numbers will already be out, so you can look to see that, make sure that this is right. We're probably going to see another 250,000 jobs added to the payrolls. There's still 10 million jobs available that can't be filled because the labor market is so tight. But other than that particular set of good news, and actually because of those things, you're going to see the Fed raise short-term rates again, maybe 50 basis points, maybe 75 basis points at the end of the month, early October. So in saying what house prices are going to be, She said, I'm going to sell my house now. I said, good idea, because it's unpredictable. But one thing you can predict is that you missed the high. It's good to sell now because you're just off the high. But 6 months from now, shoo, you could see house prices in many, many places falling. And in those places that are falling, there's a top 5. There's always a top 5 list, right? And I always have them handy right in front of me. Okay. Where prices have dropped the most by county. Okay, this is a county, not city, not state, but by county. Don't ask me why my statistics are like this today, but they are. Counties have to have at least 1 million people in their population. And here's number 5. Fairfax County, Virginia. Okay? How much do you think they went down by, or are going to go down?
Probably 15%.
7%.
Oh, well.
Santa Clara?
Nothing.
Santa Clara? You got a number there?
Santa Clara, that's Silicon Valley.
Yeah.
Oh, that's got to be 10.
7%, you see? But no, think about this. If you're going month to month and you're watching this and you're watching how prices, yes, last month they went up 14% year over year. However, month to month, they've been coming down 3 to 5 to 7%.
You said 14?
Pardon?
You said 14, so that was pretty close to my 15 then.
Yeah,
Okay.
year over year, it went up, not down.
I know.
Okay, so number 2. Come on. Place called Travis, Texas, 9%.
What is Travis County? What?
Well, Travis County, Texas, right. Where is that? Is it Dallas?
I
Is
have
it
no
Fort
idea.
Worth? It's Dallas-Fort Worth. Okay.
Okay.
Alameda County is the number 1 on the list. Alameda, of course.
San Francisco.
Absolutely. And that 11%. Now, these prices and where they're going are going to spread quickly. In 98 out of 100 counties, prices for real estate dropped last month. 98 out of 100. I would say that's pretty much a slam dunk. The prices are falling. Now, year over year, as I said, they're still up. So we're dealing in this type of uncertainty, but anybody who's been in the business, who's been around a long time, knows that this isn't the first time this has happened. Now, there's a sort of a dragging our feet slowly towards the recession. That's really what's happening. So whether it's end of first quarter, second quarter, beginning of third quarter, next year is going to see demand really drop. Now, why do I say that? Because the Fed is raising their short-term interest rates. That's why. Because China is still in lockdown. Because oil, and by the way, have you looked at the gas prices?
Yeah, every day.
What is the deal with the gas prices here?
It's crazy.
I'm in California, for those of you who aren't. We are, well, go on.
Yeah, they had a guy from AAA on the news a couple of nights ago. He said that there had been some plant shutdowns in some of the refineries, and that's the excuse they always use, though.
You know,
And then our governor said he was going to write a letter to...
oh, he's going to write a letter.
And the letter was going to ask them to go to the winter blend immediately.
No, I saw that.
And it was going to save us like 15 cents a gallon. So it's no longer $7, it's like $6.85.
It's unbelievable. The rest of the country is paying about $3.60, $3.70 a gallon, right?
Yep.
We're double that.
Mid-sixes,
Right.
most places. Yeah.
It's unbelievable. It's just, when I hear, and California has oil. This isn't like a state where there is no oil. We have our own refineries. We pump our own oil. It just makes me so angry when you are getting ripped off. They're doing it, and there's such impotence in government. This is one thing, and I'll go political for 1 second, that I didn't mind about the ex-president, because he would just blast people. And sure enough, things did happen. Now, I don't know whether it happened because he blasted them, but man, somebody needs to take these oil companies fleecing California out to the woodshed. Oh my. All right, let's move off that topic. Okay, so as I said, jobs report. Okay, we got about a minute left quickly. Jobs report is going to be about 250,000 jobs added, which is a good thing. We should continue to see jobs created. There is a strong quit rate still. There is a strong need for good and skilled workers. However, as I said earlier in different shows last week, week before, whether it's on YouTube, whether it's on Twitter, whether it's on any number of other social medias, around Christmas time, you're going to see some pink slips. just the way it is, especially with the recession coming. You're going to see people want to boost their share price, so a lot of public companies are going to do that, and private companies are going to do it because the demand is not there. You're already seeing it in the mortgage and real estate business. Anyway, I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening each and every week. You can hear us on 5 different radio stations in 3 different states. We always plug these terrific channels. They bring the message, not only my message, but message of other producers of shows, plus great music and some other things. Down in Albuquerque, the K-Mine and K-Mine country, and in Las Vegas, Nevada, at KSHP, K-Ship, 1400 AM. In Tahoe, K-Tahoe. What are the call numbers? I mean, what's the number on the dial?
Best way is the best way is ktahoe.com.
Excellent, ktahoe.com. And in Southern California, which is kind of our hub, it's KMET as well as KCAA. Both of those stations have been, well, we've been with them a long time, and they really provide great service, always give me, great coverage in all of those areas, new towers, new programs, new ways by which you all can listen and tune in. If you go to the radio stations, most of them have archives and you can hear past shows, but certainly sign up, say you like it. You'll get automatic alerts as to what's happening next week or next time I'm on the air. Thanks very much again. I'm Jeff Barton. This is The Mortgage Voice. Okay, so most of what we do and say is about opinion, but not the opinion that you need. The opinion you need are from the experts we bring on the show. This is the micro, the people that deal with the people in each and every transaction. With us again, once again, is Jennifer Conrad. She is a licensed LO in a lot of different places, and I bring her on now. Jennifer, how are you?
I'm doing great, Jeff. Thank you so much for having me back.
Thank you very much. Okay, so you have a college student. How's that going?
He's enjoying it. We're embracing college life, so things are good. Just changes the schedule some, but everything's great.
Great, and I bring it up because there are many people in this economy who are, they're working and they have older children, and the expenses are more in college, obviously, than high school or grade school because there's a big tuition dollar. When you are getting a loan or giving advice to someone getting a loan and they have college debt, how do you handle that? What do you do with that? And what are some of the guidelines that we can follow with that?
If they are currently having student loans that are not reporting on their credit report, they're actually paying it, like they're not actually paying it, I'm sorry, like if it's in a deferment state,
right?
Then we're usually going to count 1% of the balance on that, unless it's an FHA loan. If it's an FHA loan, we're going to do 0.5%. So a lot of times I will talk to borrowers and say, you know what, if it looks like we're possibly going to have to do that, and the 1% is more than what you might get as far as like an income-driven payment,
right.
Then a lot of times I'll tell them call their servicer and see if there's a possibility that they can be set on an income-driven payment, and as long as we have that in writing, we can use that.
Okay,
Whatever
good.
it comes back as the payment, we can use that towards their debt-to-income ratio. So that actually can make a huge difference in whether or not a deal has a debt-to-income ratio that is too high and it kind of knocks us out of a category, or if it brings it back in line so that we can actually do the program.
Let's talk about debt-to-income ratios and how that impacts a borrower's ability. Rates go up, that's going to affect your debt-to-income ratio. What are the income ratios now that you would need in order to qualify for, just a general 30-year fixed?
For a 30-year fix, we generally want to be under 36
okay.
and 43. Written, it's a little bit lower, but as long as we can run it through automated underwriting, whether that's Loan Prospector LP or Fannie Mae DU, and we get an approved eligible, there are a lot of lenders that will say as long as the findings say it's approved eligible, we'll go off of it. So it really depends. In some cases, if we have other compensating factors, low balances on credit cards, high assets, we can go up sometimes as high as 46% on our back-end ratio, which is our total ratio, which is what your your monthly payment for your home,
Right.
as well as all other debt is going to be.
Okay, now if we're talking FHA, what are we talking?
FHA, you can probably go a little bit higher.
Uh-huh.
We still want 36% on your housing ratio, but for the back-end ratio, we do actually have up to 55%. And
Okay.
in some cases, we have 56. I have one now that has a 56%. But again, we have a borrower who has a 760 credit score, and she does have additional assets in the bank, but she didn't want to use them. So that's sort of a compensating factor. And I think, DU or, LP will pick up on that. And a lot of times, like I said, as long as it comes back approved, eligible, or accept through LP, the underwriters will take it.
Now, these are all loan types that are purchased by either Fannie and Freddie or Ginnie, right? That's what we're talking about.
Yes.
What about a
Right.
non-QM product, something that isn't purchased by a government-sponsored agency, but something that's sort of independent, non-QM? What are the ratios there?
Well, with the non-QM loans, it really depends, because if we're talking about a bank statement program, or we have some lenders that'll do just a profit and loss program,
Right,
they generally want us under 45%.
right,
But if we do one of the programs that we've just recently been offered, which is a no ratio loan for a person who's purchasing a primary residence or refinancing a primary residence, then we don't necessarily have a debt to income ratio because we're not using any income. It's just a matter of
right.
you putting 20% down on a purchase, or a maximum of 65% loan to value if you're doing a rate and term or cash out refinance.
Now, most of the time we don't talk about very specific items on the show like this, and the reason I liked it and wanted to do it today is to really demonstrate that there are a lot of different options for loans. Most people today,
Yes.
because they see rate going up, oh, I can't get a loan. And I think that's further from where you really need to be focused, which is what can I qualify for in this vast array of products out there? And I guess a lot of the lenders are trying to come up with new programs to be able to offer, entice borrowers in to borrow.
They are. Like I was saying, we have a no ratio program now for a primary residence, which isn't anything that I've seen before,
Right.
where,
No.
we don't use any income. But then we also have a lot of lenders, who are looking at borrowers who are currently in their homes. And I've had a couple of people approach me in regards to the fact that they want to pay off credit cards, but they don't feel obviously they would want to refinance their primary mortgage
Right.
because maybe they have a rate of like 3%. So
Right.
we're now offering standalone second mortgages, and it can go up to 200,000 or more. Just a HELOC loan that is available to our clients. And I've had a couple of borrowers tell me, hey, my rate on it that they offered me was like 7-8%, and that's cheaper than the interest I'm going to pay on my credit card. So then in that case, this program works for them. And even if you have, parents who are needing to pay for college,
Right.
I mean, ultimately, it gives them an opportunity to be able to take it and then have that equity line to be able to pay for college.
Yeah, I think all of that it's showing that not only is there a lot of options for whatever you're looking for, but it also says, hey, look, because the rates are rising, banks are willing to try to do more to get you into a property. It's not about, oh, I'm trying to get you into the loan because I need to make money. That's part of it. But most of what this is about offering solutions to people who are looking to either purchase or, as you just said, get some money out of their house because they need it.
Right. Mm-hmm.
So, okay,
That's true.
the popularity of which of these programs have you seen more recently, since rates really have gone up quite a bit?
Definitely more what you call the non-QM, non-qualifying mortgage loans.
Right.
That for sure. But then I personally have had 4 clients who've been interested in the home equity line of credit.
Okay.
The thing about that is it's more or less, we kind of do the initial, let me put your information into the lender's site. The lender decides whether or not the borrower is qualified, and they sort of take it from there and run. So then the client has a lot more, power and control to be able to choose whether or not they want a 15-year amortization or 30-year, the rate, all of those different things. And so people can customize that more to what their needs are and what they feel comfortable with.
Right.
So that's sort of where my clients are more interested in it at this time.
Great information today, Jennifer. We are up against it, and I really appreciate you coming on. Tell people how they can get in touch with someone who, as I said, has a lot of loan officer licenses in a lot of different places and probably could help a lot of different people.
Well, you can always reach me at 773-593-6831, or you can call the office and ask for me.
Excellent. Thank you very much. This is Jennifer Conrad from Malibu Funding. I'm Jeff Barton, your voice in the, in the radio world, in the mortgage business, whatever it is.
Both.
Both, all that. Thanks, Jennifer. Thanks for coming on.
Thank you for having me, Jeff.
Sure. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Hello and welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. We are on YouTube. YouTube houses most of our video and most of our online shows. I mean, we do LinkedIn, we do Twitter, we do Facebook, certainly Instagram, and we also, as on YouTube, we do an hour show a week, the radio show that we broadcast to 5 different stations in 3 different states. They're all housed on YouTube, and so if you want to see us, go to Jeff Barton, the Mortgage Voice on YouTube. Sign up. You like it. All these things help other people get to us. You can't find the information that we have in the format that we do it anywhere else. You can get lectured at, but what we try to do, especially in this particular segment, is have a little bit of a conversation with someone who really knows what's going on. And as the fly on the wall, you get to hear exactly what is going on in the business, some of the solutions we can talk about, and some of the problems that might be out there as well. Anyway, no further ado, Chris Calderon joins me from Forward Lending. Been on the show before. Chris, how are you?
Good afternoon. How you doing, Jeff?
I'm fine. Thank you very much. Okay, the million-dollar question. How you doing in this crazy volatile market with rates going up the way they have been?
You know what? Considering that I've been doing this 20 years and I went through that subprime meltdown,
Yep.
Everything's happening in slow motion in a good way. I've seen this before, so, nothing new. Some tough times, and what goes up must come down, and what goes down will eventually go back up.
Yeah, you say slow motion, and I was referring earlier in the show to how this particular market seems to really be in slow motion. We have conflicting evidence in the economy. We have, yes, we certainly have rising interest rates, but we also have a real estate market that's still, price-wise, increasing. So employment has a different look to it than we normally would see in a down economy. So we're not quite sure, and I think it's slowly grinding towards a recession at some point next year. But how is this affecting both the programs that you're offering and the business that you're, obviously trying to get in the door?
So, it's affected in a couple different ways, right? Obviously, there's less business today than there was, say, as recently as 6 months ago. Obviously, we've seen the refinance market drop off.
Right.
But at the same time, we've been able to kind of overcome that by offering HELOCs.
Right.
So, if you've got a lot of borrowers out there that have an extremely low interest rate, but they want to tap into their equity,
Right.
There's $13 trillion of equity Americans are sitting on. So it gives them an opportunity to keep that great rate that they got that will probably never come back ever again, and at the same time tap into their equity. So that's been helpful there. And then as far as certain products and stuff like that, we try to stay pretty aggressive. We really haven't rolled too much back, with the exception of rates changing. We've been able to stay pretty steady with the products that we offer.
Okay, give us an example of a couple of products that you think are hot and products that you think can really survive through this tough time in rate-wise.
So one of the products that's probably been, the biggest hit is we have a FHA 100% financing program. Now, this isn't like a CalHAFA or TRADAP program where, you have income limitations, et cetera. This is our own proprietary product. So it just simply runs off of FHA guidelines. And right now, you've got a lot of people that still want to buy, right, but they're reluctant
Right.
to, put their entire savings in for the down payment. And, as I think we're getting nearer to recession, hey, what happens if I lose my job? My savings is taken. This allows that person to get the house they want, not have to use any money for down payment, right? So they can keep their savings, get the
Right.
house they want, and then the year they can go ahead, refinance out of that program, right? Lower the payment, lower the rate, and they still have the house they want. So that's been one of the big programs. And some other programs that we have are the Dscr Program, which
Right.
is really good for real estate investors, he or she who owns a bunch of properties or wants to get in, and you just qualify just using the rental income of the subject property. And then we have a lot of good programs, P&L programs, bank statement programs for self-employed borrowers, and those have really, really taken off. I'd say maybe September of last year, bank statement DSCR programs was maybe 5% of our funded volume. Last month, for the month of September 2022, it was a little over 36%.
Wow,
So
that's a
it's
big
just grown
change.
exponentially
Yep.
in 12 months.
Yep, absolutely. You mentioned that the 100% program was proprietary. Does that mean that you do not sell the loans, you keep them in-house?
No, basically what that means is the program that we have is unique to us.
Oh, I see.
Right.
Okay.
So that's what I mean. So it's our own guidelines. The only overlays we have, no manual underwrites, no 3 to 4 units, and no high balance.
Okay. Now, when you're pricing that out, you price it out like an FHA loan. Is that what it is?
Yeah. So you price out like an FHA loan. The price is going to be obviously a little bit higher than a regular FHA loan where
Sure.
somebody was putting 3.5% down. But again, this program isn't designed to have the best rate. It's designed to get the person in the home. And then in 12 months, if they want, they don't have to, but if they want, they could refinance out of that program, pay off that second, lower the payment, call it a day.
Now, right, and it's also not a hard money loan. This is
Correct. A regular FHA government
right.
loan.
Right, and as you say, the rates might be a little higher. So I guess rates being a little bit higher is most likely 8%, even though that could change.
Yeah, no,
quickly.
you're going to be maybe in the high 6s to low 7s on this.
Oh, okay. All right, I understand.
Yeah.
Okay, so that's. I mean, if you look at conventional today, I don't know, was it about 6.4%, down from 7 last week?
The average rate on a 30-year fix right now for a prime borrower conventional is a little over 7%.
Right.
Maybe it's fluctuated a little bit down, a little lower after last week where pricing slightly improved. But we're seeing rates that we haven't seen at this level since 2008. And if you want my opinion, I think rates are going to be a little bit higher by the time we get to the end of the year. I think we might see rates jump up a little bit more.
Do you think the raising of the rates, cooling of the real estate market is something that is it's obviously good for buyers who want to buy cheaper, but do you think it overall is good for us to be in a position whereby we are behind the 8 ball in terms of our real estate business, our real estate, because real estate itself is about 25% of the economy, and not only here but around the world. I always feel that it's messing with a good thing, even though the good thing was kind of killing us. I'm in a mixed feeling about this. How about yourself?
Again, it's one of those things. Imagine someone, everybody loves pizza, right? I mean, you want to gobble up as much pizza as possible, but at a certain point, right, your doctor's going to say, your cholesterol is getting a little too high.
Right.
And we got to put you on a diet to bring that cholesterol down, get your weight down, right? And it's kind of like the same thing. If you follow me with that analogy, I think things were just going too fast, right?
Mm-hmm.
And you had home values just appreciating at an unprecedented rate.
That's true.
Before,
Yep.
Even in the subprime era.
Yep,
So,
that's right.
I think that this slowdown, although begrudgingly, and you and I are both in the business, right?
Yes, we are.
It might be. I think it's the best thing for the market right now because it gives an opportunity to bring some people back into the market that otherwise couldn't afford to buy. Even though rates are higher, as values starting to soften, it will allow some people that maybe were left out the past 2 years to kind of jump back in. Maybe not at the rate they'd like, but again, eventually the rates will come back down and they could always refinance out of it.
Are lenders or your particular folks over at Ford, are you reevaluating appraisals, i.e. you're lending on less of the appraisal value than you were just because you're worried about a recession, or is that not happening?
No, not at all. We haven't taken that approach at all. If the comps make sense, then we're going to roll with it. No, not at all. I don't think it's affected our underwriting, whether it's the credit worthiness of the borrower or the collateral, the property. No, it hasn't had any effect.
Okay, so crystal ball me for a little bit now. We're 6 months down the line. You know, all the hullabaloo about what's going on in the political world, and we're into a new sort of time. And where are we in the spring of 23?
Well, there's two trains of thought on that. Best case scenario, right? The rate hikes that the Fed has done will do their job, get unemployment up, and I know that sounds, odd to say, but that's one of their main goals, and get inflation down, right? And maybe what we might see in spring, maybe second quarter, is we might see rates start to come down. Now, I don't think we're ever going to get back to those 2.75, 3%, but maybe we might be able to get back down to the mid-5s, which is historically where rates typically tend to be. So some people that have purchased or refinanced, in the past, 3, 4, 5, 6 months, they'll have an opportunity to refinance and lower their payments. That's best case. Worst case, I think we might be 12 to 18 months of a very, very stagnant market.
Right.
And so, like I said, if you're a wishful person, you're thinking 6 months. But realistically, it might be 12 to 18 months that we might be looking at this. Depending on who takes back the White House or who keeps the White House. There's all these different things that are kind of come into play as well.
Sure, excellent. Hey, Chris, thanks very much for coming on. You always give great opinions and facts about what not only is happening at Forward, but what in general going on in the market. Thanks very much for coming on.
You got it, boss. You guys have a good day.
You too. Thank you very much. That's Chris Calderon from Forward Lending. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show. We are reachable everywhere, not only on the internet, not only on podcasting. We certainly are on Celestial Radio and on YouTube, but we also do a weekly minute to 5 minute show either on LinkedIn or Instagram or Facebook or Twitter. We try to reach people where they are as opposed to making them come to us. Now, that may sound like we're tooting our own horn a bit, but the information that we have and what we're trying to do in order to get you this information is to make sure that you have the best possible information to make the best possible choices. There's a lot out there right now, and it's scary for a lot of people who just don't know the business. The experts we bring on the show, they do know the business. And one of these guys right now is Michael Chapman from Chapman Real Estate and Finance here in Southern California. Michael, how are you?
I'm doing well, Jeff. How are you?
I'm fine, thank you. And thanks for coming on the show. I always appreciate your perspective about what's happening. And thanks, again, for coming on the show.
Yeah, you're welcome.
Okay. You told me off air you got a deal down in Florida. I was talking earlier in the show about what happens when you're in a weather situation or in a situation where disaster happens. It's very difficult to try to get those loans closed without a reinspection. Tell us the story about what's happening with this particular loan down in Florida.
Yeah, I mean, this is one of these files where everything that could have gone wrong did. We were set to close before the hurricane happened, and I've got co-borrowers that are in California and the occupied borrowers in Florida, obviously.
Right.
And the co-borrowers in California signed their docs a week before their final loan documents, a week before the hurricane happened.
Oh, man.
And FedEx lost them in the mail, overnighting them to the borrower in Florida. Just one of those crazy things. They ended up in Tennessee. They showed up today, but now it's too late because the hurricane happened.
Right.
So anyway, fortunately, this is why you really want to work with, when you're buying a house, you want to make sure you're working with someone that knows what they're doing, that the wholesale lender or whoever's going to fund the loan has leeway and can make extensions of the lock. You don't want to go to some like fly-by-night shop that's just promising you low rates, because you're going to be screwed if things like this happen. Anyway, we're working on it right now. I think you were just talking with Jennifer, my processor, on the deal.
Yep.
And she's ordering the reinspection, and we got it to go through the original appraiser. So they're going to make sure that it's structurally sound. It is. I've seen pictures of the house. There's some shingles that may need to be replaced, but there's no flooding in it. There's no structural damage. So, and then, like I said before, you want to be working with lenders that have good relationships with their investors, because they were able to extend the lock without any cost to the borrowers.
Okay, so as the miracles that I've seen coming out of Florida, the people that get saved, and all those particular stories, this is kind of a miracle too. I mean, you had a double header here. You had, the lock extended, which doesn't happen, and then you also have the ability to close based on no structural damage in the property. That's really, really amazing.
Yeah, the girl who's moving into it, she just sent me pictures of the house. Beautiful house. Really, very close to the storm, but was able to, make it through it. Like I said, there's some glass damage and shingles as you'd expect. But fortunately, we're about wrapping it up and going to be able to get her a new home. So.
Oh, that's excellent. That's good news for the borrower, obviously, to get into something that they've been waiting for, especially with the fear of something might happen to my new house kind of thing. And I'm sure the seller is relieved as heck to get this thing done as well.
Well, it's actually, yes. This has been a rare pre-foreclosure house.
Oh, I see. Okay.
The bank, there was a bank actually selling it. Yeah, some backstory, but anyways, the agents and the bank that's selling it, they're all relieved, that they're going to be able to get this wrapped up.
Well, in our business, experience, yes, it's good to get an experienced lender, but really an experienced person to be able to handle the transaction, walk it through. I know I've worked with you several times on difficult deals, just being able to hold everybody in it, work through the solutions that you can work through, make sure that, whatever information needs to get to who needs to make decisions gets there calmly, efficiently, and in a timely manner. That's on you. So that's a great job on you. Congratulations.
Yeah, we've talked about this before.
Right.
There's kind of two different categories of lenders. There's the stuff that you see on TV and commercials and whatever, and that's fine if you don't know where to go. But like my clients, they're largely referred from real estate agents, and we work as a team to get them, prepped and a plan of attack to buy a house. And then there's a lot of times where someone will come to me and say, hey, is this the right time to do this? Right time to refi? Because I look at their lifelong clients, I'll say, no, let's wait for 6 months till something happens. So you really establish trust with people with that, where it's not like I'm just trying to push a loan on people that don't necessarily need it.
Well, there's plenty of those companies out there, and you mentioned what's on the radio or what you're listening to. Yeah, because the overhead and the way that they operate their businesses really depend on a steady stream coming in the door. Whereas who you're going to have for, like I say, a long time, 10, 15, 20 years, probably do 3, 4 loans with somebody during that time. You want to make sure you're giving them the best possible advice rather than just churning loans.
Right, that's right. Yeah, and it's all about relationships with your referral partners and with your past clients. That's how you can be a smaller operation like this, be very expert at what you're doing, and make sure everyone's getting a really fair and competitive deal, because you're not dependent on one loan here closing, and there's no desperation. It's all about taking care of your clients over a long period of time.
Okay, so in the business right now, you say you're when we talked off air that your business has actually been pretty good. Well, I can see why. Obviously, problem solving is a big deal, but you can't solve rate, right? I mean, you wait around, you try to work through it, you try to work around it. What are your clients looking for? Is rate been an obstacle for them? And are there solutions other than, like you say, I think we should wait 6 months?
Yeah, great question, and absolutely, like everyone, it's definitely had a dampening effect on business.
Right.
There was a little window this summer where rates came back down in the high 4s if you were with a good competitive lender.
That's right.
Low 5s, and then it went back. And I think right now, once we get through this month, we're going to see mortgage rates start to go in the right direction. That all being said, something I'm doing to kind of bridge the gap right now, because there's plenty of people that need to buy a house,
right?
For whatever. And something you can bridge the gap is what's called a 2-1 buy down. You can do a 1-0 buy down as well.
Right. Explain that. Yep.
Yeah, so you couldn't really do it 6 months ago because it takes a negotiation with the seller. It's similar to when you would negotiate a contract and you'd ask the seller for concessions for closing costs. So in this case, let's say that the seller wants to sell a house for $500,000. It's a nice round number, and you come in and say, okay, look, you have a conversation with the agent. You say, do you think this is going to appraise for $510? If we ask the seller to put in a concession, that's effectively buying their rate down. Okay, so it's
right.
kind of like paying points. And what it does is it so right now rates are in the low sixes, low to mid sixes. So if you do a 2-1 buy down, you're going to get that rate at 4.25, or whatever whatever the market rate is. It's 2 points lower than that. So
okay.
for the next 12 months, your payment will be based on like in the fours instead of in the sixes. Okay, and then after 12 months, it goes up to 1 point. That's why it's a 2-1 buy down. There's 2 steps.
Okay.
So it'll go to like in the mid fives, and then it'll finish off after 24 months. It'll go back to the market rate that you locked it at. But during that time, the idea is, and this is a good way for me to keep in touch with my clients, is that there's no prepayment penalty. So if rates come back down again, you can refinance it. And so it's a way to, like, if you need to buy a house right now, this is a good way to keep your payment from being exorbitantly expensive, and get your foot in the door and acquire property and let the appreciation build. By the way, we're still, even with the high rates, because of low inventory and a number of factors, Zillow and all of these assessors of appreciation are still seeing appreciation going forward. Now, it's slowed down.
Yep.
But a lot of people are confused because they're hearing price reductions in the media, and they're thinking that values are going to drop. That's not the case. There's not enough inventory for value to drop. What's happening is that appreciation is slowing down, but it's still appreciating. So it's still a really good investment to get into property right now.
Excellent.
So,
No, and that's a great explanation. I had the similar thought when I was talking a little bit earlier on the show, so you reconfirmed what I was saying, and I do appreciate it. We're up against the clock, of course, and we always are rushed to get off, but I really appreciate you coming on. The information's excellent. Thanks, Michael. Thanks very much.
Thanks a lot, Jeff.
Thank you very much. That's Michael Chapman from Chapman Real Estate and Finance. Hey, Michael, shout out your phone number for people in case they want to get in touch with you.
Yeah, appreciate that. 619-888-3049. I don't have a phone assistant. I always take calls directly and like to get to know my clients. So 619-888-3049.
Thanks again, Michael. Thanks for coming on the show.
You're welcome. Talk to you soon.
Talk to you soon. And I'm Jeff Barton, your voice in the mortgage
You're
industry.
listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. Jeff Barton, voice in the mortgage industry. Thanks very much for tuning in to the show this week. We really appreciate it. There's some volatility in the market, but if you want to catch up with what you have missed, hey, go to our website, The Mortgage Voice. It's mortgagevoice.com. It's a great place to see old shows, check profiles of guests who have been on the show, and be able to connect with me or anybody that you see on the show directly from the website. It's a good place that we house a lot of the shows, especially a lot of the archive shows. You can also go to YouTube. That's The Mortgage Voice. Jeff Barton, The Mortgage Voice on YouTube. All of these places have ways by which not only you can get in touch with me, but you can review and see what you've missed. And there's a lot of things that have changed, but what hasn't changed is the information that's relevant and important and up to date. Click that you like it, sign up, and make sure that you get the alerts of future shows when they're coming. I'm Jeff Barton. This is The Mortgage Voice. And again, thanks for tuning in. Okay, so we got to some of the rates that are happening in the mortgage marketplace. 6.65 for the 30 years, 6.05, as I said, for the 15, 6.48 for FHA, 5.85 for the jumbo, and 5.95 for the 5/1 ARM. The 10 years at 3.685, and the 2 years at a tick or two over 4%. Now rates have come down, and the yields for the bonds have come down. That's usually a good thing. Usually they work in reverse order. If in fact the demand is better for bonds, it means that the yield can be lower, but the price they charge can be higher, meaning that if you're going to buy these because you like a 4% spread, even though inflation's at 7-8%, you'll be paying a little bit more today because, as I said, the yields came down, which means the demand is higher. Demand is at center for a lot of things happening in the housing market. The housing market itself is, last week we reported that it was a little bit into a recessionary mode, that it was kind of looking whether it's either going to be a correction or a crash, and there's a lot of debate in the industry still about exactly what that is and what does that mean. Is a 20% or less a contraction, or as they say, a correction, or is it 20% or more that is a crash? Well, the predictions, not mine, but read them. They're all over the internet. Go to housingwire.com if you want to see the latest in terms of a lot of very interesting stuff. HousingWire is a good place to go. You got to pay for the information, however, so just be aware that when you go there, you're only going to get, 4 or 5 freebies, and then they're going to want to have a payday. So being that what it is, the housing market, as I said, is it a crash or is it a correction? I'm of the school where it really doesn't matter what you call it. And the interesting thing about what the economy is doing, whether it's a recession or whether it's not a recession, what's the practical aspect of what's happening in both of these areas? People are nervous, so that means that they pull back a little on spending. Although last month consumer spending really went up. It's confounding in some respects, because you have a tightening in the money supply. You have the Fed rate going up, which means money is taken off the table in terms of what the overnight borrowing costs are for these major banks. So they have to keep a certain amount of money in their particular, not coffers, that's a wrong word, but in their accounts in order to satisfy the liquidity requirement. All of these things really take money out of the system, yet you see the consumer still spending. So there's still a lot of money in the system. When will that evaporate? How soon will we see whether the economy is as strong as consumer spending seems to indicate it is? But there's all this momentum towards recession, and that momentum is carrying the housing market. And obviously, with mortgage rates last week, we had them over 7%, haven't been that way for 20 years. Now they've settled back down, which is kind of the way it's been all year. We saw the rates go up a lot in January and February. They went from 2.5%, almost all the way up to 4%. Then they settled back down in the mid 4, mid 3 ranges. Then it spiked again, and now it's spiked again, but now it's settled back down into the mid 6s. I do think we're going to continue to see mortgage rates go up. Let's see. Yeah, I have it here somewhere. It is right in front of my face. Okay, so the Market Watch predictions. I went to a site just to see what other people think, because I think housing prices are going to go up a little bit more before they settle back down and before they begin to decelerate below what they've sold for a year ago. That's going to take 3 or 4 more months before the amount of money in the system is dried up and the buyers can't afford the mortgages anymore to the tune whereby the seller has to drop price. However, if you're looking to buy a mortgage, those mortgage interest rates are also going to go up, which is going to kill your demand. These two things in combination are going to bring the housing market, yes, not to its knees, but certainly below the 20% correction. I think we're going to go a little bit beyond that. So what do other people say? I went to a couple of websites, came up with a list of the top 4 things, or 4 things that you got to look at in terms of what's going to happen in the housing world. Number 1, mortgage rate will continue to rise. That's a no-brainer, right? Everybody knows that. It has been rising. I just sort of not documented it, but gave a brief history of how it would go up really high, then settle back down a little bit, but never as low as it was. Number 2, continued deceleration of home prices. There again, that's probably where we're heading. And as I said, it'll take a couple, 3 months before we see some negative growth. We're predicting, or not me, this particular group of websites that I went to for the information said by the year end, we'll still be seeing about 5% year-over-year price increase, but down from 22%. But you can see there's really been a 17% drop of the acceleration in prices to 5%, still going up, but again, decelerating. Number 3, lots of variation between markets. Now, we all know that's true, and anybody out there who's in the flipping business, anybody out there who is looking for some kind of opportunity, this is the time where you get your sleuth hat out in your area and figure out exactly where the opportunity lies. Is it the street next to yours? Is it across town? Is it, are you talking Las Vegas? Are you talking Denver? Are you talking Miami? Well, not Florida, and those poor people in Florida. Do you see any of that? Has it happened?
Oh, just horrible, yeah.
It's just horrible. I mean,
just blocks and blocks and blocks flattened.
It's incredible. And that's okay. Let's just divert for a minute. So, weather-related issues like Florida. I do some business in Florida, and there's no lending in Florida until they get people out to make sure that whatever you're lending on is actually there, and they're probably going to have to do some structural assessment on a lot of these properties, especially in those areas. What's the big one that was hit?
Well, Tampa,
Tampa, but
Fort Myers Beach.
Fort Myers, that's the one I was thinking about. Right, it was just awful. Anyway, for those people, I feel terrible, and obviously we give a little bit, give what you can. Anybody who's generous enough to help all of these people, and again, I always say it: disasters are terrible, but they bring people together. I don't care whether you're red, white, blue, or orange, however you vote. When there's a disaster, people come together. That's the way it is. That's the way it should be. And again, I hate that disasters mean, that let's put all the rest of this nonsense aside and get together and do something. But that is what's happening. So I kind of like that. I was in one myself a few years back, big fire. Again, for a week, I was just handing out food to anybody who came up. I didn't care. It's a good thing about what we do here. I think a lot of people all around the world do that, but we certainly do it here. All right, so number 4, buyers will have less stressful shopping. Now, that's true. If we're going to find prices that are dropping, if we're going to find mortgage rates rising, we're certainly not going to find a buyer or 10 for every property. So therefore, the reason by which buyers will be less stressed is because there will be less of them. Therefore, there won't be in competition for a good piece of property. If you're sniffing out something that looks like they want to sell, that may be underpriced, now's the time to jump on it because there's less competition and you might be able to get something which is really worth more than you're paying for it. And in a market like this, that's a pretty good deal. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning in. We'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.
KCAA, where every day is a great day. KC